Welcome to Wise Up Governance and Boards podcast, brought to you by 3 Wise Owls Governance Consultants. Covering hot topics in governance, risk, latest regulatory changes, and issues keeping directors and executives awake at night. Here are your hosts, Ainslie Cunningham and Deb Anderson.
Welcome to another episode of Wise Up. Today we're joined by AnnMarie Rodgers and Maria Newman from Marsh. AnnMarie is a Senior Vice President and leads the Queensland corporate segment for Marsh, world leader in delivering risk and insurance services and solutions, and part of the Marsh and McLennan group of companies. A Fellow of the Australian and New Zealand Institute of Insurance and Finance, AnnMarie started her career in Glasgow and has 30 years insurance industry experience in the UK and Australia. In her current role, AnnMarie oversees client service delivery and insurance solutions for clients and is also responsible for business development in Queensland. Previous roles include client account management, new business and insurance program placement in local and international insurance markets. Her client servicing experience spans a wide range of industries, including real estate, retail, manufacturing, food and beverage, utilities, aviation and government entities. Welcome, AnnMarie.
Thanks, Ainslie.
So Maria is the Managing Principal and Vice President of Risk Management at Marsh. Maria is a corporate insurance broker and risk advisor with over 20 years' experience in design, placement and management of complex insurance programs. Maria is an accountant by trade, having completed a Bachelor of Business with a major in accounting and a Master of Business Administration with a finance major through QUT's Business Graduate School of Business. In her current role, Maria works with a diverse range of clients from ASX 200 and multinational companies to government-owned corporations across several industry sectors, including real estate, retail and consumer goods, infrastructure, manufacturing and aged care. Maria has expertise in property and casualty lines with special interests in managing multinational programs, insurance due diligence and contractual insurance and indemnity reviews. Welcome, Maria.
Thank you, Deb.
So, ladies, how has the insurance market been playing out presently?
Pretty difficult conditions at the moment, I think, for many clients. Some industry sectors, I think, are finding it more challenging than others. And obviously, depending on the size of your organisation and the amount of capacity, etc., that you're looking to for the market to provide to you, you might find that pretty challenging, particularly around directors and officers' liability, as we were talking earlier, but also even on the property side, depending on the industry sector and whether it's considered high hazard or. But look, I think it was already a challenging market going into 2020, and having COVID obviously has made that a little bit more challenging. It's been an interesting year.
So, Maria, what other challenges have you seen in the market at present?
Yeah, definitely. So, on top of what AnnMarie's mentioned, obviously pricing has been an issue across all different segments of insurance, be it D&O or property or casualty. In the Pacific, we've experienced 14 consecutive quarters of pricing increase, with the largest one having been in Q2 2020. In terms of capacity, that's also coming down quite significantly. Insurers are wanting to write less risk for a higher price. They are dropping down their deployed capacity. They're not really wanting to write new business. They don't have the appetite for new business like they do. They're not focused on growth at the moment. They're really focused on getting their books back to profitability.
So has there been impacts from the bushfires, etc., from a NatCat climate change property perspective?
Yeah, definitely. So like I mentioned before, it's been going up consecutively since 2017 anyway, but definitely the events of late last year and early this year in terms of bushfires and weather events have really exacerbated that. I mentioned before that the pricing increase as at Q2 2020 for property policies across the Pacific was around about 31%. So that's quite large. I mean, it's increasing at an increasing rate as well. So and we're not out of the woods yet. in terms of what insurers are doing now as well, I mean, this whole, climate change risk and changing physical risks and extreme weather events, it's really forcing the need for insurers to make more investments on new tools and new modelling to enable better decision-making for them in the long run. You also see the Insurance Council of Australia, for example, working more with governments and communities to really increase and strengthen that resilience of communities against natural disasters. So you'll see that the Insurance Council of Australia, they're working around, with government introducing stronger building codes, implementing, improved land use planning and all those stuff are all happening now. So definitely climate change is at the forefront of, the insurance market's minds and government's minds. And yeah.
Are there any exclusions being introduced as a result of these changes?
Look, I think insurers are looking really closely at the risks that they rate, and so the answer to that generally is yes. But you might not find that you have a total exclusion on a policy. It might be things where they'll look at the sublimit that they're providing, whether it be flood or whether it be action by the sea or cyclone or bushfire, depending on the region that you're in. So you have to look pretty closely at the terms that you're getting back and what's on offer. As Maria mentioned, looking at different tools for our clients, the things that we talk to them about is making sure that you've actually got a good understanding of what your Nat Cat risk is, rather than rely on the insurer to come back to you with an offering. So if you undertake certain studies, whether it be for flood or for earthquake or bushfire or the like, but get an idea of where your exposure actually lies across your property portfolio, have a good understanding of that, and then obviously critically look at the offering that insurer might come to you at your next renewal and see how that actually responds for you in relation to running your business.
I think in terms of that tool that AnnMarie is referring to, this Nat Cat modelling tools, I mean, Ainslie, you and I experienced that working with each other in the past life, doing that exercise and just the tremendous insight and monetary benefit it ended up having. Yep. Once you really assess and know what your real exposure is, and then make appropriate, insurance procurement decisions based on that science.
Yeah, absolutely.
So what sort of impact has COVID had on the insurance market? Obviously, there's the question there is the share are a lot longer because they're asking a lot more questions. But what other impacts has it had?
Look, I think we're still yet to see what ultimately the impact's going to be because, certain clients will have had coverage under their policies and some might not. There are a number of claims, obviously, potentially be paid that the insurers haven't yet paid out. So in terms of the monetary value around that, I think that's yet to be seen what that impact is. But certainly in the short term, if you didn't have an exclusion for infectious disease cover before, you will have it now. Yeah. So again, as an advisor to your client, looking at their business, what that actually means for you. What that might mean for you in terms of being able to, not being able to transfer that risk now, but how you're going to actually risk manage that. And, obviously it impacts different businesses in different ways. And, I've had conversations with some of our clients where a certain business model, there's been growth, but since COVID, that's changed now. So that they're having to rethink, where potentially they might be sort of focusing in terms of their business growth and their business strategy and objectives over the next few years, because what they thought they had perhaps is not quite the same as what it was before.
Yeah, it's definitely changing the insurance market. From a claims perspective, obviously we don't know what the full outcome of that yet in terms of its economic value. But there are already some indications from Lloyd's that it's even higher than all of the 3 hurricanes combined in 2017. For example, you've got Irma, Maria, and Harvey. It's more than that combined. It's actually the single largest, provided their estimates are fairly accurate in terms of how policies would respond. It's actually the single highest sort of catastrophe compared to those other natural catastrophes that we've had in the past. The insurers are really potentially facing catastrophic losses. We don't know yet how the policies would respond. It really depends on and I'm talking about business interruption losses here, because that's where most of the contention is in. Like, you've got event cancellation claims and travel claims. They're pretty straightforward. We pretty much know what the outcome of claims from those policies are. But in terms of D&O claims or liability claims and property claims, there's still a long way to go before we really know what that looks like. In the UK, they just passed a decision, the UK High Court, for that FCA test case, and that's really, overall in general, that's looking in favour of policyholders. It will probably get appealed, so we'll wait and see what's going to happen there. In Australia, there was a test case as well, similar but narrower in scope than the UK, around how business interruption policy should respond. I think that was heard early October, the 2nd of October, by New South Wales Court of Appeal. So we're yet to hear what the judgment is on that, but that could potentially be impacted by the UK decision as well. Yeah.
And I kind of wonder how the cruise industry will be impacted, because they're kind of twofold in terms of business interruption. They're losing in the millions on a daily basis, as well as the potential for liability and class action sort of claims being brought against them by, passengers or people who've lost their lives.
Definitely. It's not surprising. When we hear about it, we shouldn't be surprised that, a class action of some sort has been brought against, because, it's probably bound to happen.
So obviously, as a risk manager, insurance is predominantly a risk transfer strategy, but with almost 2/3 of the damage off the back of natural catastrophe in the US being uninsured, that would leave millions of people and businesses exposed to a large protection gap. What can businesses be doing to strengthen resilience against climate change and natural catastrophes going forward?
Well, we've touched on it a little bit already in terms of NatCat modelling. Okay, so having an understanding of your risk is probably the most crucial thing, because, like you say, you can't simply just transfer that. Depending on the assets that you have, and you can look at it in a couple of different ways. You can have an accumulation of assets in a high hazard area, or you can have linear assets which might cross a number of different areas. Looking at it from a NatCat modelling perspective, it's one of the things that Marsh advises its clients, get a good idea around what that looks like for you, so that you can make an informed decision in terms of, if you can buy insurance, you know what limit you need to buy. So you can obviously optimise the premium spend. Equally, if you have, you might be prepared to take higher retention levels on certain types of catastrophe losses, if that obviously suits your organisation. Other areas, whether it be flood, cyclone, again, the same thing applies. It really is just getting that understanding of what your exposure is. If you can buy insurance, how affordable that's going to be for you, and make the decisions from there. I don't know if you've got any other thoughts on that, Maria.
So, on top of that, obviously that's a really good way to identify and quantify what your exposures are. It just places you, in a volatile market that we have now, it places you in a better position than other insureds competing for capacity. But in addition to that, I think really looking at managing the implications of, natural catastrophes and climate change risks, looking at the implications of that to your business, reviewing your business's resiliency plans, your business continuity plannings, asset and supply chain resiliency, all those stuff. That's one of the best ways to really look at how those risks are implicating on your business and how you can manage that.
I suppose one of the things as well is that, when you're actually looking to ensure this, and Ainslie's Maria said you've had experience of this before, you look at something, you say, well, look, I might need $20 million worth of cover, but unless you actually go through that exercise and actually understand why that is the case, you could be putting yourself in a position that you're buying cover in areas that doesn't have that same level of exposure. So it's making sure that the underwriter who might be rating your risks knows what that exposure is. You may also say to me, yeah, but surely they do their own modelling, and they probably do. But they're not always necessarily, depending on where they're located. Quite often, if you're transferring risk into an underwriter in London, for example, they might not be buying the most up-to-date modelling software. Okay, so being able to be in control of what you're actually presenting to the market, and this is the key thing, is the presentation to the market and painting your risk in the best light that you can. That's where you get the advantages as well.
We've got this running joke in the industry that London underwriters just think that the whole of Queensland is either underwater or on fire. So they don't really know. If you say Brisbane, they think it's all flood zone.
Yeah,
it's not.
So in terms of climate change, are you seeing insurers expecting carbon emission reduction targets for clients, or not quite yet?
Not quite yet. I don't think. Yeah, we're not seeing that yet. Obviously, I think they factor that into their modelling, but yeah, it's not something that they are sort of pushing on clients. I don't think they really can do that yet. Yeah.
I think it's interesting. Maria and I were having a chat in the last couple of days, and probably something that you're aware of, Marsh and McLennan participates in the World Economic the production of the Global Risk Report for the World Economic Forum, along with Zurich and Tunis and others. So it gives you a broad brush or a broad sort of spectrum of views across business and government and academia, etc., in terms of what the top risks are. That report was released February 2020, and that virtually all of the top 10 risks were all environmental or climate change related. That's what people were focusing on. So yeah, whilst insurers are obviously looking closely at that, our clients and businesses are looking at that as well. It's seen as a major focus for them in terms of not only just buying insurance, but in terms of their own risk management and their own how they're running their business.
And I think too, with change of government, etc., globally, there could be some sort of government mandated targets.
Yeah, absolutely.
So in terms of directors and officers insurance renewals, what are some of the challenges that companies are facing with their insurance renewals?
Fun topic. Fun topic for most directors and officers. So, definitely pricing and capacity. They're the two main challenges that insureds are now facing. So, according to Marsh's benchmarking data for ASX 200 clients, renewals in the first 2 quarters of this year, premium spend in that space is up 170% on average. In some extreme cases, they're up 600%. And then retentions are soaring as well, up to 300%. Worryingly as well is the shareholder or the securities class action that's impacting on the ASX listed company space. That's reverberating as well into all of the D&O policies for small to medium-sized enterprises and not-for-profits. So for some not-for-profits and SMEs, it's actually getting to the point of unaffordability now. So across Marsh's SME and not-for-profit clients, renewals this year are up anywhere from 40% to 200%. Retentions for ASX listed clients are, soaring into the tens of millions, and in some cases, some extreme cases, hundreds of millions. So insureds are now holding much more of the risk that insurers used to hold. But even with that, you're still seeing insurers exiting from the market. Like you've got Allianz, for example, exiting from all long-tail liability claims, so that includes D&O. And that's, again, impacting on the whole supply and capacity of insurance, which is then driving that price. It's like a vicious circle. So, pricing and capacity definitely are where the challenges are.
And are you seeing some exclusions on Royal Commission from those policies?
Look, I suppose depending on the industry, the aged care and the like. I think it's look, again, it's just a challenging market. So yes, and certain insurers, come in, they'll want to add their exclusions on there. Giving yourself enough time to make sure that you actually have some options and you can actually sort of look closely at any of those exclusions or limitations they're putting on a policy is really important. Don't leave things to the last minute, because if you do think you want to have a conversation with them, you want to sort of examine exactly what those sort of exclusions actually mean for you and your organisation. So, yeah.
And there have been, I think I've heard of some certain exclusions being applied on certain clients. So it's not a broad brush exclusion being applied across for certain clients. And as AnnMarie said before, for certain industries, there have been some exclusions being applied on certain policies around Royal Commission. So the implication of that is, if anything is going to come about from the Royal Commission, you should already know that. So you should be reporting that already. So that's when the importance of timely notification, because as you know, D&O policies are what you call claims-made policies. So the importance of timely notification comes in, because the intention of the exclusion is that notify to us now everything that could come out of a Royal Commission before your renewal, because if you notify us after your renewal when the exclusion comes in, then it's no longer covered. So clients, insureds can still have the protection as long as they notify it before the exclusion comes on.
It's just that transparency, isn't it?
That's right. Yep.
And so in terms of the parliamentary inquiry into class actions and litigation funding, how are you seeing that impact the D&O space?
Look at it will obviously have an impact. I mean, insurers, as we say, they're not necessarily going to be in a hurry to write new business, etc. So I think all of this coming in will improve the situation. But look, when Maria mentioned sort of earlier, just with COVID, I mean, when you look at potentials for class actions sort of coming, around that, I don't think that's going to go away. I think a bit more rigour and legislation around how those can be conducted will be a good thing, and I think that will have a benefit towards how the insurance market then responds.
Yeah, I echo that. I mean, it's when there are parliamentary inquiries and royal commissions, I mean, obviously what comes out of that is increased pressure in terms of higher levels of compliance and standards. So with that, underwriting from insurers would also become tighter. They'd want more information as well around how you're managing those solvency risks and all those things. So I think in terms of how it impacts, insurance market and insurance renewals, it's just really on, insurers putting more scrutiny in terms of how directors and companies are managing their business.
So with given so many increases across so many quarters consistently, presumably the market is expected to harden further. What can boards be doing now to ensure that they have continuous coverage and that they retain and attract the right director talent around the board table?
Yeah, that's really, that's a conundrum, because it's, if you don't have the right protection and the right levels of insurance, why would anyone want to be a director when their personal assets could be at risk? So being a director in this climate, it's I don't envy that, that position. It's hard, but there are ways that you can ensure, coverage continues at least to some level. It might not be to the level that you want it, but at least to some level. And also ways to, again, better position yourself in a market where you're competing for very limited capacity. So firstly really examining the coverages that you have now, and looking at what those cover and whether you need it. The thing that most insureds did back in the soft market, when there was a lot of capacity and pricing was fairly cheap, was that, and we do this at Marsh, we call it, we've got a colleague that calls it the squirrel effect. It's like in the soft market, when times are good, you gather all your nuts, you put all the bells and whistles, and you put so much fat in your program when it doesn't cost you much or anything at all, so that in the hard market you've got a lot of fat in your program to give away when you need it. So that's so really looking at, reviewing at what coverages you have. Do you still need it? Do you need that much? We're seeing also more clients taking more actuarial-based decision-making in the D&O renewals. So Marsh has a tool called the Ideal tool, which is a benchmarking tool, which really tests the appropriateness of insured's limits relative to their size and the nature of their business. So that's, using tools like that really help with ensuring coverage. Also, insureds might opt for a higher retention option as well to mitigate those pricing increases. And sometimes, those higher retentions are out of choice. Sometimes it's forced. Sometimes insurers don't want to attach until, at a much higher level. So when you are going in that pathway of increased retention, really making sure that, your company has the plans and processes in place to manage those below deductible losses.
I think also, Ainslie, just to your point around, what can organisations do in terms of attracting the right type of director or talented directors. I think if you're on a board, if you're a director of an organisation, is, making sure that you understand, I suppose, the impact on your D&O cover that those business activities are going to have, and take a really keen interest in what's happening with that insurance renewal as well. I suppose our approach is where we can, in terms of D&Os, to ask our clients to actually sort of be involved in that presentation to the market. One, nobody knows your business obviously better than you do, and therefore if you can sort of talk through what your risks are, what your risk profile is with an underwriter, that's really important. But equally important as well is giving, for us perhaps going into boards and actually giving those board presentations about what the drivers are and what an insurer's perhaps looking at and what's going to be the driver in that next renewal. Because if you sit in a number of boards, it may be different for each different organisation, as you'd know. So just getting an idea of what that means for you and being involved in making sure that you've got as Maria says, you've got the broadest coverage come renewal.
Yeah, definitely.
Yeah, so the challenge really is finding that right mix, level or right balance between, the mounting cost of insurance and the, right mix or level of protection for directors. So, companies and directors potentially, facing a decision to reduce coverage or eliminate coverage in certain areas. So it's really important that you have an understanding of what you have, and then the insurance market also has an understanding of your business. In terms of anything sort of more creative, on the larger scale, some larger companies, and it doesn't need to be, a very large company, they're turning more into captives. So from January to July this year, Marsh created 76 new captives. So that's about, if you look at year-on-year growth, that's about a 200% year-on-year growth. So more where they can do it, where it's appropriate to a company, they're turning more into captives so that they can sort of remove themselves from the volatility of that market and have more control around how they're transferring that risk.
So for the benefit of our listeners, Maria, can you explain what a captive is?
Okay. I'm not a captive expert.
For us, we've got it down pat, but yeah.
In a nutshell.
In a nutshell, it's basically the insured forming their own insurance company. Don't ask me how you do it. You can do it in certain jurisdictions where you form this company, like Bermuda, I think, is very common, where you can form these captive companies. But essentially, it's creating your own legal entity, which is an insurance company, and then you then have control over how things are underwritten, how things are priced.
And you obviously only underwrite your own risks. You're not open to other third parties.
Yeah.
So if an organisation was interested in looking at that, obviously size and premium spend is a big driver, size of the organisation. It's not going to be appropriate for every company. But you can do a pre-feasibility study and whether a captive option would be, attractive and a possibility for you. And then if that looks as if it's, that could work for us, then you can go into then sort of doing an actual feasibility due diligence and what that would mean and what risks that you might choose to transfer in there. Over the years, sometimes companies that I've been involved in have transferred only their first-party risks, their property risks, etc., but not the liabilities. But organisations I'm talking to now, interesting, you were talking a little bit about professional indemnity insurance earlier. For certain industries, professional indemnity is a huge premium spend, and capacity is really hard to find at the moment. So, certain clients have said, look, I just don't know whether over the next couple of years we're going to be able to, afford this or actually want to transfer all of that risk into the insurance market at that price. So perhaps we should be looking at captives to transfer risk that way.
Quite a long lead time on captives, though, isn't it? It's not the sort of thing you can sort of decide 2 months out from your annual renewal.
You don't. You really need to be thinking at least the next 12 months and maybe even beyond that, because there's a lot of due diligence involved and there's obviously a lot of work to do leading up to that. I suppose on that point there are other alternate risk transfer ideas such as discretionary trusts and the self captives, which might be a little bit more straightforward. But yeah, look, again, discretionary trusts for certain clients is a way that some of our clients have sort of been going. Different risks are probably work better than others, depending on things like claims and what that looks like. So you've really got to do the modelling again. You'd probably take sort of 3 to 6 months for that at a minimum as well, because you would do the modelling around what your losses would be, what the technical prices being transferred into the market are, and how you would set the price for the discretionary trust. But at the end of the day, what it gives you is a bit more control and not just riding that market cycle and waiting for things to get better. Yeah.
And do you still use market assessments in terms of obtaining quotes from the market to price your captive accordingly for future renewals?
You would. So essentially what you're doing is the captive underwrites the risk, but then you're looking to reinsurers to then sort of reinsure out. So essentially that's the same process. Yeah.
So in terms of historically where D&O cover has been hard to obtain and Australian markets have looked overseas and predominantly London market to obtain cover, have you seen a change in their appetite as well recently?
Yeah, for sure. Yeah. Look, it's I think that there's been a contraction in that market as well. I think there's been price increases. London's not the only, I suppose, market entry point that you would want to look at. We've had clients, and again, it's not just necessarily just Asia as well. For Australia, like, certain Asian markets and London markets were always the obvious ones. But, clients, we've used North American markets, Canadian markets, for a number of different risks. So, yeah, I think you've got to be really conscious of what you're actually going to market with, where your best entry points might be. But because London's just not the saviour for everything. If I can't get in Australia, I'll go there and I'll find the capacity, because that's not necessarily the case.
Yeah.
Particularly around construction, those sort of risks as well.
Yeah, construction, PI and all those things. But yeah, I mean, London is not what it used to be, I guess, in terms of, you used to be able to use London as competition for your domestic market. Now you pretty much need both, especially for D&Os when you're filling quite a large, high tower program. You're pretty much going to need both Australian markets and London market to give you all the capacity that you need, because you just won't have enough here in Australia for larger programs. And I guess in terms of profitability in London as well, I know like Lloyd's of London has undergone sort of review of their syndicates and the profitability of their syndicates, and some syndicates, well, all the syndicates were forced to sort of revise their business plan and present that to Lloyd's as to why they should continue on, and some couldn't really come up with a plan to be able to continue profitably. So there are actually a number of syndicates that have been shut down. So that, again, reduces that capacity available in the market.
So with those sort of high tower programs, are you seeing an increase in the number of layers?
Yeah. Because what's happening now is, again, in the soft market, you used to be able to get a primary limit for, say, 20 million or 30 million. You're not really getting those primary limits now. I think you'd probably be more likely to get 5 million or 10 million limits now. So you really need more insurers to jump in and fill that tower if you want to maintain that limit. Some are even forced to have a lower limit because they just can't fill it with enough capacity.
And obviously that will have potentially an impact on price as well.
Yeah. The more insurers you have there, then the more. Yeah.
So I think you said before that there's been some insurers like Allianz that are sort of pulling out of the market. Have we got any new entrants coming into the market?
Not really. I mean, in Australia, Berkshire Hathaway, they've been around for a couple of years now. They're doing really well. They have a different business model where they don't use reinsurance, so everything is underwritten. Everything comes out of their balance sheet when they pay out claims. So they have a slightly different way of underwriting. It needs to be a really good risk for them to underwrite it. But yeah, I mean, if anything, there's just consolidation of insurers that's even driving the capacity down. Like you've got AXA XL, or you had XL Catlin, and then now AXA XL, Chubb and Ace, two really large insurance companies globally, and have now merged. So all this consolidation, there's companies exiting, but there's really no one new coming in.
I suppose what I would say is looking broadly at the risks that you're trying to place into the market, you might find that you're using insurers that you wouldn't have used before. So that's what we're finding. So your traditional markets, property markets, for example, that might have written something 100%, might reduce that to 50%, and then you've got to make up that other 50%. And sometimes some of the smaller niche-type markets or underwriting agencies are coming in to help fill placements that you didn't have to turn to previously. So, yeah.
And have there been quite a few travel claims because of COVID?
Yeah, there has.
I think there would,
Yeah, there has. Insurers have paid out on those. So a lot of cancellations, obviously. Obviously, companies are also not travelling now. Or executives are not travelling, and so the interesting thing coming around is when you're actually going through that renewal and saying, well, what does your next 12 months look like, which is very different to what it looked like before. So making sure that you can actually sort of most organisations are maintaining cover, but in a different way. So you might be paying, say, a minimum deposit premium, and then sort of looking to sort of make a declaration to insurers sort of later in the year, rather than sort of declaring trips that you probably won't
be taking.
Not going to have
international travel in the next 12 months.
No, and that's the thing, is because there's this economic contraction. Means you have less people traveling. Businesses are earning less money, less revenue. There's that. That's really seeing insurance companies lose premium volume as well from this downturn in the economy. So they will have to make up that lost premium volume somewhere else through, again, further increases in what's already increasing.
Are you seeing, as a result of COVID, with a lot of people working from home and things like that, are you seeing any changes to EPL or any type of sort of programs like that are around employees?
Relating to employees?
Nothing in terms of changes. Nothing marked. I mean, it's a professional risks product, and therefore it's a difficult market. So our company's seeing increases and some limitations across those covers. Yes, to a certain degree. I think in terms of how you actually manage your workforce is certainly of interest to those insurers who are writing that. So they want to know what your, what your strategy is, what your COVID plan is. That's a separate questionnaire completely, which has to be filled out in terms of those sort of covers. So not huge changes that I've seen for any of our clients on EPL, Maria. I don't know if
not so much in terms of policies itself, in terms of terms and conditions or premiums and exclusions. But more so, I mean, we're probably still yet to see it if it happens. But there's definitely, a changing risk or an increased risk in terms of, workers' compensation policies. I think more. I know we did it at Marsh, where we all had to make sure we're all ergonomically assessed and things like that at home. So there's definitely increased risks to your workforce and their well-being from that. In terms of the EPL, look, we're yet to see it, I think, because, again, speaking about the economic downturn and when there are employees being laid off, you'd typically see claims against companies coming out of, I know GFC, for example, when that happened, then there's a lot of employee layoffs happening. We did see a fair bit of claims happening in that EPL space. COVID, we're yet to see it, whether there will be some claims coming out against companies. It's a bit hard. It's a different situation because GFC was more, they're being laid off because of financial management or mismanagement, however you want to look at it. But this is COVID, and it's like it's no one's fault. It happened. Everyone's affected. So do we really want to sue? Sue the company that made us redundant or something like that for dismissal? It's a bit different context.
I think too with the JobKeeper and the job seeker payments still.
That's definitely helping.
It's been helpful.
Yeah, it's propping them up still.
But certainly underwriters will take an interest in how you're actually managing that workforce. Another interesting thing is just in terms of risk management is the mental health of your employees and making sure that you're looking after. I mean, organisations that have those protocols in place and actually have sort of introduced sort of new ways of working and systems and look after their employees in that way, I think will benefit. So those are all the sort of things that underwriters are going to be really keen to understand in terms of your workforurce, I think.
Even like EAP programs in place
correct.
And things like that.
That's exactly right.
So definitely more information are being required because of COVID.
Yeah. Well, we know ourselves, even going through new renewal at the moment. So you briefly touched on it before, AnnMarie, with exclusions around infectious diseases. So with sort of specific pandemic exclusions coming out at the moment, is that something that can actually be put on as an endorsement?
The exclusion put on or the right back put on?
Right back. So actually saying, well, no, we do need pandemic cover or infectious disease cover, or is it just flat out exclusion?
It's pretty much a flat out exclusion. Yeah. Different insurers obviously have different wordings. But no, you pretty much
can't get cover.
It's not subject for challenge. Because I think many insurance companies will argue that pandemics were never intended to be covered by those, property business interruption policies because you can't really model them. They're pretty hard to model. So, but the wordings, have never really, the wordings have never sort of fathomed something like this happening. So there are some avenues for insureds to make a claim for, infectious diseases. But so now every renewal that happened since March, there are standard London sort of wording exclusions around pandemics. So, flat out exclusion for communicable diseases. And that's also driven by the reinsurance market. It's not just your insurance company that's doing that. It's driven by their reinsurance because they can't get reinsurance for it. So it's not for challenge, I'm afraid.
And are you finding the aged care sector are being challenged with the Royal Commission and the pandemic as well, getting reinsurance?
Yeah, look, there's a number of different issues. Obviously, we had the Royal Commission now with COVID coming in as well. I think what we will see is the potential again for going back to the class actions possibly where, residents, families of residents are sort of looking to bring actions against certain aged care providers around their sort of management of that and handling of that. So they were already in a challenging time, and obviously going through much more scrutiny and governance, etc. I think COVID's added to that. So certainly the aged care sector is definitely facing a few more challenges, I think, as we go along.
And again, what we're seeing in terms of PI, med-mal type renewals and public liability renewals, insurers are now having their own sort of addendum questionnaire that they need insureds to fill out. Without that information, they'll apply a total exclusion as well on the liability for diseases. But certainly the aged care sector is under, tremendous pressure, even more so than they used to. I mean, you've got the Royal Commission, you've got the introduction of the aged care quality standards in July last year, and then, just looking at the high vulnerability of elders to, for death or to be severely, sick from catching COVID, they're certainly under enormous pressure. In addition to that, I know last week or the week before, they announced, in the federal budget, $1.6 billion worth of funding for the aged care sector. So, of course, that's not going to come without the, additional obligation and onus of, higher compliance and higher level of care. So,
And with a lot more organisations potentially accelerating their technology strategies in terms of digital transformation, going online, Zoom meetings, people working remotely, have you seen an uptick in cyber cover that clients are taking, or?
Yeah, look, it's always on the agenda. And it's always, when you go through a strategy meeting with your clients, then obviously cyber liability, etc., definitely has to be one of the risks that you're talking about more frequently. What I would say is that in terms of cyber policies, not one size fits all. So depending on your business and your organisation, make sure that the policy that you're buying is the one that's going to respond best to your needs. And probably the key thing about any cyber liability policy that you might buy is seeing who those service providers are behind. So if you do have a cyber attack, if you do have a breach, that you've got the right service providers in terms of the investigation, the PR, all of that is the right service providers that you've got that you can work with. That's probably more important than the actual, what limit that you buy is making sure that you actually have that service available to you.
Yeah, definitely.
Read your policy.
Yeah, absolutely. Yeah,
but so many people don't. They don't even know what cover they really have.
And I think it's been quite a few years now since cyber sort of first came out, but it's very difficult to sort of think, well, what's going to happen? What does that mean? And there's also a bit of, is it a cyber liability breach or is it crime? With social engineering. And social engineering is obviously huge in terms of sort of risk. And I can't imagine there would be many organisations that aren't, have either experienced it already or going to. So looking at how those policies actually dovetail together, if you have a crime policy and you have a cyber policy, how those work together is really key as well, and understanding the coverage. But again, going through the risk profile for your business is a really good exercise to do, rather than just say, how much will underwriter ABC offer me, and how much is it going to cost? That's probably not the place to begin.
Yeah, it's not just about filling in an insurer's proposal form and say, get me quotes, and then I'll get the cheapest one. So it's not like that at all. I mean, it's, at Marsh we even do this, we have a self-assessment form which really looks at the level of cyber maturity of the particular business. And that also translates into a proposal form to the insurance market. So insurance market accepts it as a proposal form. So that's a really good start, because it gives you an idea of where you're at with your cyber maturity, where you need improvement in your cyber resiliency, and then what's the appropriate policy that suits that.
Well, I think that's about all we have time for today, ladies. Is there any sort of top tips you wanted to leave our listeners with before we wrap up today?
if your insurance renewal is coming due and you're not thinking about it, I'd say start thinking about it. This is a year where you have to allow yourself as much time as possible, not just to go out to market and get alternatives, but to actually think about what you're purchasing and how much that might cost you. So if your broker hasn't spoken to you about insurance that's due either in the next 3 months or 6 months, you should be thinking about it really carefully, because it's not going to be a case of, look, it'll all work out. Some clients are finding that it doesn't quite work out as they were expecting.
Yeah. There's a lot of surprises. So if you're not there early, then you'll get your surprise in the last minute, and you're forced with terms and conditions that you're not necessarily happy with.
Great tips, ladies. All right, well, thank you so much for joining us today, AnnMarie and Maria.
A pleasure.
Thank you.
Thanks
it's
for
a pleasure.
having us.
Thank you very much.
That's all for today. Until next time, happy podcasting. And remember, if you're enjoying the show, check out our other episodes and all things governance at www.3wiseowls.com.au.